Welcome to your Cornerstones textbook chapter 10, where we'll be covering stockholders' equity and some of the journal entries that go along with that. Now, when we're thinking about stockholders' equity, both preferred stock and common stock, we have to think about what happens when we issue the stock. Either common stock or preferred stock both come with something called a par value. The par value is an arbitrary face value which represents the minimum price on that stock. Now, the value of any common or preferred stock in the common stock or preferred stock account will always be the par value times the number of shares that were issued. Now, sometimes shares are issued for more than the par value because remember, par value is the minimum amount that share of stock must garner in the market. So if the company is able to issue their common or preferred stock for more than par value, then the amount above par will go to the additional paid-in capital account, either additional paid-in capital common stock or additional paid-in capital preferred stock. Now, the common stock account, the preferred stock account, as well as any of the additional paid-in capital accounts have credit balances. When stock is issued, the company receives cash. When it receives cash, of course, that will be a debit entry. Let's look at an example. Spectator Corp is authorized to issue 1,000 shares of preferred stock with a 9% dividend rate and a par value of $20 a share and 50,000 shares of common stock with a par value of $2 a share. On January 2nd, 2011, Spectator issues 200 shares of preferred stock at $22 a share and 20,000 shares of common stock at $2.50 a share. Now, before we go any further, let's just look here. Did Spectator issue all of the preferred shares that it's authorized to issue? No, they issued 200 shares of preferred. They're authorized to issue 1,000. Did they issue all of the common shares that they're authorized to issue? No. They issued 20,000 shares, even though they are authorized to issue 50,000 shares. So right now, the company is authorized to issue 1,000 preferred, but there are 200 outstanding as of January 2nd. They are authorized to issue 50,000 shares of common, and there will be currently 20,000 shares outstanding. Now, in each case, preferred and common, they were also able to issue them for more than the par value. Par value of preferred was $20 a share, and it was issued for $22 a share. The par value of common was $2 a share, and it was issued for $2.50 a share. First question, how much cash did Spectator raise through the stock issuances? Well, they got enough cash to equal the 200 shares of preferred stock at $22 a share and the 20,000 shares of common stock at $2.50 a share. The total cash is going to be the $4,400 of preferred, $22 times 200 shares, plus $50,000 of common, which is $2.50 a share times 20,000 shares, or a total cash received of $54,400. Now, second question, what would the journal entry be to record this issuance of stock? Well, let's first look at the preferred stock. Remember, the company received $4,400 in cash from the sale of the preferred stock, so we would deal with cash of $4,400. Remember, the company receives cash every time they issue shares, so it would be a debit to cash of the $4,400. Then we need to make a credit entry to preferred stock, the preferred stock account, and that's going to be in the amount of par times the number of shares. So par of $20 times the number of shares is 200, so that'd be the $4,000. Remember, they got a full $4,400, so that extra $400 goes into additional paid-in capital preferred stock, and that's the $400. That's going to be a credit also. Let's look at that all nice and neat, typed out. The full amount of cash is a debit up here. Par times the number of shares is going to be entered as a credit into preferred stock, and anything above par times the number of shares will be entered as a credit value into additional paid-in capital preferred. Now let's look at the entries we'd make for common stock. How much cash did they receive for their common stock? Well, they got the $2.50 a share times the 20,000 shares that were issued. So we will have in our cash account $50,000 of a debit because they received $50,000 of cash. In our common stock account, we will have the par value of $2 times the 20,000 shares that were issued. So that's $40,000 of common stock. And then in our additional paid-in capital account for common stock, we'll have another $10,000. Why don't we look at that all typed out? Cash is going to be based on the total number of shares and the total amount per share. The amount of credit we enter in the common stock is going to be the par value times the 20,000 shares, and then anything above par value, which is 50 cents a share, right? The difference between $2 a share and $2.50 a share. That 50 cents a share times the 20,000 shares is going to be the $10,000 credit. Our 40,000 and our 10,000 add up to $50,000. So we have everything in order. Now let's try to see what happens to the Stockholders Equity section of Spectator's balance sheet. Now we assume that Spectator was a brand new company, so that there had been no previous information in its Stockholders Equity section before everything happened on January 2nd, 2011. Remember, there was $4,000 of par value of preferred stock and $40,000 of par value of common stock, so we entered both of those. Those had been based on par value. Then we had the additional paid-in capital of preferred stock of the $400, additional paid-in capital for common stock of $10,000, and all together they had on their Stockholders Equity section $54,400 total of capital stock, which just so happens to equal the amount of cash they received on January 2nd, because remember, January 2nd was the first time they issued shares. If you also note, in this company's balance sheet, there is a $0 retained earnings because we believe that Spectator had no previous operations, which means it has no earnings to have retained from the past. It has no past yet, which means total capital stock plus total retained earnings comes to total stockholders' equity of $54,400. Now, what are some of the ways that a company can distribute cash or value, at least, to its shareholders? It can repurchase shares from its owners, where, in other words, the company goes out and actually buys back its stock, and the owners of those shares receive cash for whatever shares they sell back. The company can issue cash dividends, which is literally a bit of cash distributed from net income. So let's look at stock repurchases. Why on earth would a company repurchase its shares? Well, your book gives you some possibilities, at least. You may want to buy out a portion of the shareholders. Perhaps some of those shareholders really don't want to hold the stock anymore, and they're looking for a way to sell it at a decent price. They'll sell it back to the company. It might be that the company wants to reduce the size of its corporate operations. They don't want so many shares outstanding because they don't need such a capital base anymore. Maybe they're downsizing their corporation. It might be that they want to reduce the number of shares that are outstanding so that they can increase their earnings per share. And when you increase earnings per share, and this is something you'll learn in a corporate finance course, but as a company's earnings per share increase, oftentimes that convinces the current shareholders to sell or buy them for more money so the market price can go up. It might be that the company wants to acquire shares to transfer to its employees, or they might need those shares to use to buy another business. Sometimes when two companies merge or one company buys another company, it actually doesn't pay fully in cash. What the purchasing company might do is actually exchange its shares for the new company. The last reason, and sometimes a very common one in bad economies, is that businesses will buy back their stock in order to reduce their own vulnerability for an unfriendly takeover. An unfriendly takeover is when a single entity, whether that's a person or a bank or a group of investors, attempt to buy up all or much of a company's stock in order to take it over for themselves. And if you want to limit people's possibility of an unfriendly takeover, then you try to get your shares out of the market. So for all of those reasons and even some others, a company may want to repurchase its shares at some point. So what happens when the stock is repurchased? Well, the total value of stockholders' equity is going to go down. You're going to debit an account called Treasury Stock. Treasury means company shares that were previously issued, they were outstanding, and they have been repurchased. This Treasury Stock account is a contra equity account. Remember, equity accounts have a normal credit balance. When you buy back stock, you make a debit entry. This is a contra equity account. When you buy back stock, you also reduce the number of shares outstanding. What happens then if you want to reissue these treasury shares? Because a company can buy back its stock one day and decide to resell those again. Well, when that happens, you would remove the original cost of those shares from the account called treasury stock. So that'd be a credit. If it turns out when you resell those shares, your resale price was higher than the original cost when you bought them back, then you would credit an account called additional paid-in capital treasury. If when you resell those treasury shares, the resale price is lower than the cost when you repurchase them, so the resale price is lower than the original cost, then you would debit additional paid-in capital treasury stock. Now, if there is not enough of a credit balance in additional paid-in capital treasury stock account to cover the size of this debit, then you may actually have to reduce retained earnings in order to resell those treasury stock shares at a price lower than you repurchased them for. All in all, when treasury shares are reissued, it should increase the number of shares that are now outstanding in the public. Again, you had repurchased up here, meaning you as a company removed shares from the public holdings. But when you resell treasury shares, you put those shares back into the public, so you're going to increase the number of shares outstanding. Let's look at an example. Same company. We're now a couple months down the road. On July 1st, 2011, Spectator repurchases 1,000 shares of its outstanding common stock. If you recall, they had issued 20,000 on January 2nd. They're now repurchasing them for $15 per share. On September 15th, they decide to sell 500 of those 1,000 shares for $18 a share. And then again on December 1st, they sell 400 of those shares for $11 a share. Let's first look at the entry we would make to record the purchase of treasury stock on July 1st. So how many shares did they buy back on July 1st? Right, 1,000. And they purchased them for $15 a share. So we know that they must have used cash of $15 times 1,000 shares, or $15,000 credit to cash, right? In order to buy back shares, you do need cash. And remember, we said when you buy them back, they sit in a contra equity account called Treasury Stock. And we debit that account for $15,000. So on July 1st, Treasury Stock gets a debit of $15,000, and that came from 1,000 shares times $15 a share. And then we credit cash for that $15,000. Now, a few months later, they want to sell some of that treasury stock. They want to take 500 shares of it. And they want to sell it for $18 a share. When they sell stock, what happens? Well, first what happens is they're going to receive cash. Every time a company sells stock, they receive cash. And in this case, they're going to receive cash in the amount of 500 shares times $18 a share. And that will be $9,000. We're also going to have to remove some of the value sitting in our treasury stock account. If you recall, we originally had $15,000 sitting in there. We're going to remove 500 shares worth of treasury stock. We had purchased them for $15 a share, so 500 times $15 a share is $7,500. If you notice, you got cash of $9,000 when you sell these things back to the public. They were worth to you, they were worth only $15 a share, so $7,500. Your company is going to now have additional paid in capital treasury stock of another $1,500, and that way we have credits of $9,000, debits of $9,000. Again, the amount of cash we receive is always going to be whatever we sold them for, the full price, $18, times 500 shares in this case. So that came to the $9,000. The amount of credit we put to the treasury stock account is based on the original cost of those treasury stock shares. They originally cost Spectator Corporation $15 a share. We are reselling 500 shares, so 500 shares times the $15 a share is $7,500. The difference between the $9,000 and the $7,500 is this $1,500, which we could also say is the difference between what they got in the resale versus what it cost them to buy each share. So that's $3 a share times 500 shares was the $1,500. Now let's look at what happens when they sell treasury stock on December 1st, 2011. Remember, now they're going to be selling only 400 shares and they're going to only get $11 a share, which is less than they'd actually purchased them back for. So it's going to cost them, they're going to receive in cash a full $4,400. That's going to be that 400 shares times $11 a share. So they'll get $4,400 in cash, which is a debit. Now, when we need to clear the treasury stock account for the 400 shares of treasury stock, at what value per share do we need to look? Well, we initially purchased them for $15 a share. 400 shares times $15 a share is actually going to be, I'm going to just go down here, $6,000 a share. I'm going to be crediting my treasury stock account. Remember, it is a contra equity account, so it has a normal balance of debit. So when I want to clear anything, I enter a credit. How do I make up the difference between $4,400 and $6,000? Well, we told you what you would do if you resell treasury stock for less than its cost. Then you should make a debit entry to additional paid-in capital treasury stock. Now, it would seem we should make an entry for $1,600. That's the difference between the cash you received of $4,400 and the value of that treasury stock, which was actually $6,000. The problem is, if we go back one slide, we see that right now this company only had a balance of $1,500 in the additional paid-in capital account. Their treasury stock additional paid-in capital only had a $1,500 credit balance, which means I cannot enter a debit entry of $1,600. That's just not going to work. There isn't enough credit to cover it. So the most I can enter is $1,500 of debit. How do I make up that last $100? Believe it or not, I'm going to have to make a debit entry to retained earnings for the last $100. And a debit entry to retained earnings, remember, means that retained earnings is falling. Retained earnings is an equity account, which means it has a normal balance of a credit. So a debit entry means I actually just reduce retained earnings. That means on December 1st, 2011, when Spectator Corporation sold 400 shares for $11 a share, they reduced their own retained earnings in order to do it because they sold those shares for a total of $4,400 when those shares were actually worth $6,000. And this is where you see some of the math we just did. This concludes the first video for Chapter 10.